Hello and welcome to the weekly wrap video. Just a couple of things to catch you up on from the past 5 trading sessions. Then it's been a very turbulent week with a lot of focus on the emerging markets as weakness in the Turkish lira, the Indian rupee, the South African rand and the Hungarian forint, to name just a few, has caused a lot of volatility, particularly in the FX markets, following the FOMC's decision to taper QE on Wednesday by another $10 billion down to $65 from $75 billion a month. So the emerging market currency weakness caused some pretty extraordinary out-of-line policy actions from some of these central banks, starting off with the Reserve Bank of India. They hiked rates unexpectedly, followed by the Turkish Central Bank conducting an extraordinary MPC meeting, where at the stroke of midnight Turkish time they hiked rates by 425 basis points. So a pretty extraordinary monetary policy action there, which did initially support these emerging markets, the likes of the Turkish lira and those other ones as mentioned. However, the effect was short-lived as other central banks jumped on the bandwagon, with the South African Central Bank then choosing to hike rates by a meagre 50 basis points. But as mentioned, the effect was very short-lived. Concerns are whether these central banks have in fact jumped the gun, expending all their tools in the face of a stronger dollar. As such, as we head into the close of the week, these currencies really not faring well. Further record highs printed in the dollar-lira pair, with the South African rand at multi-year lows against a basket of G7 currencies. So we'll see how this pans out as we progress through the weekend, with the likes of the Reserve Bank of India governor criticising global central banks for failing to coordinate policy. This has really filtered through to the other global assets classes as the Dow Jones and the S&P 500 trigger some pretty heavy selling pressure on the back of this emerging market jitters, heading into the close of, in fact, the week and January, with some pretty substantial losses, seen as the worst month for US stocks since mid-2012. Elsewhere this week, though, we have had a raft of corporate earnings out of the US, some very large Tier 1 names reporting on a pretty mixed bias, but ending on a negative note for the week as retail giant Walmart warn on their EPS expectations, saying that a number of write-offs in regards to both India and the cold weather snap in the US affecting their earnings significantly enough to announce an outside of schedule announcement just pre-market on Friday. So as such, we look to next week to see if potentially the ECB could act. We have had some very poor CPI numbers this week, with estimates for January CPI year-on-year falling below expectations at just 0.7% against forecast 0.9%. So it's led many to believe, the likes of Royal Bank of Scotland and Deutsche Bank, that the ECB will take action next Thursday to stem off deflation in the euro area. So other than the ECB next week, we also have the critical Bank of England rate decision, which comes just a week ahead of the February quarterly inflation report, where expectations are for Mark Carney and the Monetary Policy Committee to adjust forward guidance to reiterate that rates will stay low for an extended period of time. Then to round off the week on Friday, we of course have the change in non-farm payrolls following the Fed's decision to conduct a QE taper this week. But again, there's no Fed decision for February, as Janet Yellen really takes her position as the chairman of the Federal Reserve at March's meeting. As always, we'll bring you all those releases as soon as it hits the wires, as well as any other relevant commentary to your trading. But in the meantime, that's all from me. Make sure you have a fantastic weekend, and I'll see you again on Monday morning.